So where do you guys see Kansas City right now in terms of investment strategy? There's a lot of things going on politically, like with the KC tenants.
Yeah.
I'd love to hear your thoughts about that.
I'm not going to say anything negative about the
KC tenants.
tenants.
Yeah. Welcome to the Millionaire Mentorship Podcast. Today I've got a very special guest, somebody who has built a massive portfolio out in the Kansas City region and across other areas of the Midwest. Hailing from Eugene, Oregon, the Pacific Northwest, where I hail from, welcome Jesse Worcester.
Appreciate you having me on.
Did I say your name right?
So if you're insulting someone and you call them a wuss,
Yeah.
you just add TER to the end, so it's Worcester. It's
Worcester.
Yeah.
Jesse Worcester.
Yeah.
Okay, got it.
Yeah.
Perfect. So Jesse, tell me a little bit about yourself, like your story, how you got to where you're at today.
Yeah, so grew up in Eugene, like you said. Father was a pastor of a really small church out there, mother a third grade school teacher. So we were definitely lower middle class, didn't have a whole lot growing up. Obsessed with sports. So my brothers and I have three brothers, just completely obsessed with sports. That was kind of our entire identity growing up.
Which one?
So a lot of different sports, but by middle school, definitely into high school, exclusively basketball. Wasn't a good choice. 5'8" and white is not like the.
You look like you're scrappy though.
Yeah, point guard, a scrappy point guard. But and so we all played small college basketball. But 2006, right out of school, so I played 1 year of college basketball, and the day after the season ended, I dropped out, and we started Worcester Investments shortly thereafter, 2006. So
awesome.
then we read Rich Dad Poor Dad, Intelligent Investor by Benjamin Graham, a bunch of kind of these foundational, literatures, and we had mentors and friends. We were very savvy. We had started a lot of businesses. We were very entrepreneurial from a young age.
Right.
It was a foregone conclusion that we were going to go into business. So it's just a matter of what business. And rental real estate was, from day one, we want to do apartments. So I think similar to you, we started out, we did a lot of single family homes or small unit properties. Yeah. So from 2006 to 2009, we bought about 150 units. We very quickly discovered, similar to you, that Kansas City was a great market.
Right.
Started up in St. Joseph, so smaller. We didn't come right to.
That's originally where I heard you were from.
Yeah, no. We started buying property out there. We slept in the office, showered at the YMCA.
Yeah.
And by office,
I own the property across the street from that YMCA.
Well, so the YMCA in St. Joseph.
Yeah.
Oh, really?
Is it on 8th Street?
Yeah, I'm trying to think.
I think it's the women's YMCA is where the one I own right next.
I assume there's only one YMCA in St. Joseph. It's not that big of a one. Yeah. I'm trying to. We were in the Frederick Towers, and I'm trying to remember where I would go down. It wasn't that far from there, so probably the same YMCA. Yeah. This was basement level, basically 150 square feet. Roaches come out at night, but I loved it. I mean, it was some of my most fond memories was just kind of that like scrappy building a business at the ground level. So did everything ourselves, maintenance, leasing, and this is, management, no management software, just Excel or, on a whiteboard, that type of stuff. But really formative, to do everything yourself, you kind of learn all of those nuances that I think are incredibly valuable.
I agree.
Lifelong lessons.
Guys who go right into syndications and they don't have those formative years of how to deal with contractors, how to deal with the things that go wrong.
Right.
And then they take the money of other people's money and go and invest it, and they don't have those formative years. They make a lot of mistakes.
So we did almost a hybrid because we never had any of our own capital. So from day one, even if we're buying a house or a duplex or a triplex, we were raising money.
Right.
And we had that burden from day one of, we need to first of all report to investors, like what is the performance, and that's a cadence in and of itself where there's an accountability there that I think is incredibly healthy and helpful. And so, but then as we grew, we just had the ability to scale with our investors because our initial investments did well. And then as we looked at larger and larger properties, we could go back to our investors and just friends and family. It would grow organically as, you know, we found new opportunities that were bigger and bigger. So by 2009, we had 150 units, and that was a big paradigm shift for us. So we bought in 2009 a 60 unit property. So that was kind of our big jump. So had 150 units, but 50 buildings. So an average of about a threeplex.
Right.
And this is all up in St. Joseph. Then bought a 60 unit, and that on that specific property, we hired by far the most sophisticated, advanced property manager that we'd ever dealt with. And they ran circles around the stuff we've been doing. Like, we got by and were successful because we put in long hours,
right,
and just had that sweat equity of like, we'll figure out a way.
Yeah.
But it was very eye-opening to have someone who's like, I've been doing this for 30 years. Like, there's a right way to do this.
Yeah.
And the gal we hired was incredibly hands-on and savvy, and knocked it out of the park managing that property. We did like a renovation and a lease up, you know, kind of a turnover of the building. Then later that year bought a 96 unit property, then 107 unit shortly thereafter. And that really has been the model going forward,
right,
is 100 units and above. Yeah.
And you guys have some crown jewels. You've got the 909 Walnut, which is probably the most beautiful building in downtown Kansas.
Beautiful.
It's absolutely gorgeous.
Yeah.
And some other large investments. I went to your guys' party the other day. It seems like you guys have a...
you came to our party. I didn't. Did we connect there?
I don't think so.
Oh, okay,
I was trying,
cool.
like, because I talked to somebody and they're like, come by the party. So I was like, I'll come by. But, you know...
Which one was it? Our... Like speakeasy?
The most recent one that you had.
Oh, that's so cool.
Yeah,
I literally didn't know.
Yeah, and I looked at like the little pie graph that you had on the table, and I was like, these guys are smooth. They're not trying to sell anything. They're just creating this ambiance, and you could tell there was a lot. You know, I just talked to a lot of people when I was there, and everybody was really interested in what you guys had to say and stuff like that. So I thought it was great. Was that your Flash Q building?
Yeah,
720 Main, I guess.
Yes.
Yeah. So I stopped in there. I talked to... I forget who it was, but one of your people, and they're like, come on down. I was like, all right, I'm there.
That is so cool.
Yeah.
We like to just bring people together and have no pitch whatsoever. Like, our approach with syndications is we want to know a lot of people, so be connected. And we want anyone who talks with or works with our investors to literally never sell. Like, I don't want people to even be good at selling.
Right.
I want them to be good at answering questions and being transparent and being kind and service oriented.
Right.
Add value. How can I help you understand this? You're dealing with ultra high net worth people. They're very sophisticated. They know what they want to know. They know how to make their own decisions, their own investment decisions. And so I think that is, anyway, that's just the approach we've taken. And it aligns with kind of the way we were raised. Our dad was a pastor, and kind of both our parents really dedicated their lives to serving others. So it's kind of that go-giver type of mentality of just, hey, I'm here to serve you. But on the flip side, our deals oftentimes fill up pretty quickly. And so at the same time, our people have to let people know, hey, it's like 80% full now. I'm not trying to put pressure on you, but like, if you want to, participate in this, it's maybe going to be gone in the next, short while. That's
the most interesting thing there, is because raising private money is very hard until you prove that you're successful. And then people start to talk about you and say, hey, I'm investing with these guys. They've done great. And then it kind of is like crack almost, because people want to get it on to the next investment because they know that you guys are honest, you do the right thing, and they get a good return.
Right. Yeah, we never marketed. So we started in 2006, and up until a year or two ago, the idea of marketing or even getting out in the local community here, we just were laser focused, nose to the grindstone on operating our business, buying properties, and so and our investor base just grew organically. So we never asked investors to suggest people or bring referrals or anything like that. What's that?
How did it grow? I mean, how did you start?
We would 100%. We'd be doing a deal, and people would say, "Hey, I've got some friends that I think would want to get in on this," and we'd say, "Yeah, sure." I mean, it was 100% just organic people would bring their friends.
What's the average person putting into your investment? Because it's a
Yeah.
syndication, you're bringing in.
I think it's probably in the range of, we've ran some really great data on this recently, but I think just my guess would be in the range of 2 to 250, something like that. Because what you have is people who will make an initial build the relationship, just test the waters type of, maybe a minimum, and typically our minimums are about 100.
Yeah.
But then we oftentimes have large groups that will not the endowments or the large private equity groups or things like that. Institutional capital, we've really not gone that route, but just larger family offices. So we'll have a spread, but I think the average is probably somewhere in the 2 to 250.
Can you break down what a family office is? It's a term I've just become familiar with lately, and it's being spoken about a lot.
Yes. Well, I suggest connecting with or just following Richard Wilson. He's a good friend of mine with a family office club. He's been running that for, I think, a decade at least. He's got a lot of great books and a lot of great materials on this. But technically speaking, it's supposed to be 100 million in net worth or investable assets and above. And the reason for that, like where the term family office comes from, is we have enough assets as a family to hire all our own people, as opposed to, well, I've got a CPA and an attorney and all that. We have an office of people that only serves the family. Okay. It's a vague term, or it's not a specific number, but I've heard the number, basically 100 million is about that range where you have enough assets to support that amount of staff, basically.
Right. Okay, that makes sense. And then they just kind of decide what they're doing with their money, what investments are good for them.
Yeah, and you're going to have either a patriarch or matriarch who is very involved in their investment decisions, or like a CIO or CFO, but they've got kind of a committee type process. I actually love working with these larger groups because they're very sophisticated. They know all the questions they want to ask. They want to see your underwriting. There's just a lot more of a process. And part of as we were talking kind of maybe before we started recording, part of the education that I want to do is helping maybe the less sophisticated investors understand how the family offices do it. Yeah. Because there's a system and there's a process and there's all the kind of the questions that you want to ask and the due diligence and the scrutiny. And I think there's a lot of people out there who would love to hear about how these passive investors are going through that process.
Yeah, it's and what you're referring to when you're talking about all this is basically syndications, but you guys also recently launched a fund, is that correct?
We've been doing a fund, I think we started it in 2016 or 17. Basically, there's kind of a little more to our story than just apartments. So we also co-founded Hawaiian Bros, the restaurant around here.
Oh, I didn't know that.
Yeah, with childhood friends from Eugene.
That is awesome. That is so cool. Everybody loves Hawaiian. Are you guys like tied in with the Pat Mahomes thing? Because every time I see a Whataburger and an Andy's, I see a Hawaiian Brothers.
No.
Okay.
I think there is I would say, QSR, quick service restaurants that are trying to, that are kind of that A+ brand, I guess you would say. You're going to end up in the same spots because there's trade areas and there's certain intersections where it's like, that's where you want to be. It's some of the higher priced real estate, but a brand that does high volumes can afford that.
How many locations do you guys have? I've seen them everywhere.
We're up to 55. So
holy shit.
Yeah.
Tell me about that.
That's
awesome.
It's a wild story. So Worcester Investments is purely capital and strategy.
Okay.
And so do not pretend or claim to be a restaurant or QSR expert by any means.
Right.
Our partners, the McNees, Cameron and Tyler, our parents knew their parents. Eugene isn't a huge town, but when I was a sophomore in high school, their family bought at a garage sale a Hawaiian plate lunch restaurant. Fast forward.
At a garage sale?
Yeah, at a garage sale. I actually worked. That was my summer job throughout high school and even the summer going into college. And so very close. We loved the food, loved the family. And then when Cameron and Tyler were going off on their own, we actually connected at our father's memorial service that night. We were sitting around playing cards, catching up, and kind of heard just kind of their plans about going off on their own, and we were obsessed with the food and loved them, and we said we would love to be involved and provide, capital. And we'd been kind of doing our own entrepreneurial thing for a long time, and it was a natural fit for them to come out to Kansas City.
That's so cool. I mean, so is everything with Hawaiian Brothers, is that all Kansas City?
No, so we have probably 12, 13 Kansas City locations, and then we have grown throughout Texas, Oklahoma. We're at about 9 states.
Now, are you guys planning on exiting that, hoping to get bought out? Is that the goal on that one?
I'd love to be in it as long term as possible. It's a capital intensive. If you're building the restaurants yourselves, it's very capital intensive, and that's how we grew it up to about 40 to 42 locations. And then we started a franchise model. And
bingo.
Yeah, and so that's gone very well. So we have about
bring down that model versus the other one. So with a franchise, you're selling the business to somebody else. They have to pay a franchise fee. They have to pay royalties.
Yeah.
They have to buy their product from a certain place. It allows you to grow.
Yeah. So I would summarize it as it's, I'll just kind of break it down. So a franchise comes in, and they're buying the building. They're putting the upfront capital to open a location.
Mm-hmm.
And they pay a small fee. It's the goal is that a lot of what they're paying for is to get trained and everything just set up for that new location. But really, the breakdown is the first depends on exactly how the contract is. But let's say I think ours is 6%. The first 6% goes to us, the franchisor.
Okay.
And then the franchisee gets everything above and beyond that. And
that's gross numbers?
That's net.
Net. Okay.
Yeah.
6% of their total profit.
Yeah.
Okay, awesome.
Yeah.
And in those models, when you're having restaurants, you just have to have massive amounts of them, because the one-offs, they never scale. Right?
Yeah.
You have to do that whole thing.
Yeah, exactly.
So that's awesome. Are you guys involved in anything else like that?
Well, so kind of the reason I mentioned that was with our fund. So before we started our fund, we started a private lending business. So one of our early investors was a lifelong hard money lender from Eugene.
Okay.
And so we had kind of a view into that business, and it became pretty apparent we were doing, I would say, 80-90% of the work necessary to do private lending well, which is just know the real estate market really well, know how to value properties. And so we started that, and part of that was feedback from investors. We would maybe do a deal or 2 or 3 max a year, and we had strong returns, and investors were coming to us saying, is there anything else you guys are doing, or anything else? We'd have investors miss out on deals because they'd fill up quickly. And so we said, well, if we have this, what we see as relatively low risk business model where we're lending on real estate that we already kind of know and understand.
Right.
And then on top of that, if a deal goes bad with a typical bank, they want to get it off their books. They don't operate real estate. That's not the business that they're in. Whereas with us, we're in the business of real estate. So a loan going bad and us having to maybe finish out a remodel and carry out the business plan, that's not very scary to us.
Right.
And so we had those two. We had syndications, we had apartments, and then we had private lending.
Okay.
And we basically saw the fund as a great hybrid of those two. So that is literally the structure of our fund.
Okay.
Is it's targeting 50-50 equity opportunities and 50% private loan, hard money loan. So you get the benefit of the cash flow, and it's like anywhere from 9 to 11 or 12% coupons for the investor, no tax advantages, but it's just consistent cash flow. And then on the syndication side, you have typically lower upfront cash flow, but you've got tax benefits and upside potential and kind of all of the benefits of owning an apartment.
How do you break down your syndications in terms of the limited partners versus the general partners in terms of that equity split?
I mean, so we do every deal differently. Basically, how much we always reverse engineer what we anticipate or believe investors in the market need to achieve. So for example, we might do a deal where we take significantly lower splits.
Okay.
But we still like the deal and we're still happy to own a smaller piece of it. or there might be a deal where we say, we really think this is a home run. And I would say that what we're reverse engineering is we're starting with, and everything in syndications, in my opinion, I'm very passionate about this, is the conservative underwriting.
Yes.
So it has to, the baseline is the underwriting has to be what we're sending to investors. We have to believe internally that we're going to really crush those numbers.
Right.
That should be like the conservative. We've actually recently started sending out 2 models. We do a base case and then an internal target. Because oftentimes what we found is we've said we're like really underselling this deal.
Right.
We want to be conservative, and it's good. We want to undersell it, but at the same time, we should share with investors. This is what we're going to be pushing the team. Once we close on this is what we're going to be pushing the team to hit because we think this is achievable.
Right.
We're not going to tell you that we think we're going to hit it, but we are going to share those 2 models.
It's kind of like my golf score. I could do like guaranteed I'm going to hit this, right?
Yeah.
Like, but I could do really well, and this is projected if everything goes right.
Yeah,
so you can say like this is what you could look forward to if everything goes right, and this is what you can almost plan on.
Yeah, and then we walk through. We say it's typically 5 to 8 assumptions or variables between those 2. So we walk through. We do an underwriting video, and we walk through what are the factors that would make the number on the base case? What are the factors that would cause it to hit our internal target? And then an investor can say, oh, I think 3 or 4 of those are aggressive, so I'm going to maybe lean towards, I think it's probably going to be closer to the base case. But investors can kind of make their own judgment on between those 2 scenarios. But the base case is what we send out, and we say we want investors to be happy if we hit these numbers. Even though we're hoping to exceed them, we just have to feel great about exceeding those numbers, or hitting or exceeding those numbers. And so that's kind of the starting place, is conservative underwriting. And then from there, we say, well, how much meat is left on the bone for us after we are hitting those targeted returns for our investors. So it's a wide range, basically. Anywhere from, we'll do just to answer your question a little more directly.
Please, yeah. So
we will do tiers. Yeah. So based on how much someone invests, they're going to get a higher post-pref split. We always do a preferred return.
Okay.
I've seen a lot of people doing as low as 5 or 6% preferred returns. We've only ever gone down to 7. Historically, we've done 8, but right now we're between 7 and 8. And so we'll have various tiers. And so there's going to be it's easy from a investor management and just a running of the deal. If you had 5 investors at $1 million versus 50 at 100,000, it's just way easier on us to manage that, and so we're going to give preferable terms.
So you guys are still taking debt on these deals. This is mainly for the down payment plus the carrying costs?
Correct. Yeah.
Okay.
Yeah, and we'll do the most typical model is, if it's stabilized, we'll go directly into agency, but if it's not, we'll do local bank financing.
When you say agency, for those who don't know, you're referring to Fannie Mae, Freddie, anything that's a non-recourse loan.
Yeah. Fannie, Freddie are the 2 primary, but then you've got HUD in there as well.
That's cool. So, I mean, I'm impressed. Like, I think that like each story is different. My story, your story.
Yeah.
You started a different way, but like the one thing that you figure out as a real estate investor, that anybody who's listening to this should figure out, is like eventually you run out of like capital.
Yeah.
Like, and you have to either you got to figure out how to raise money if you want to grow.
Right.
Because like, or you just grow slower. And I think what you guys have done is completely impressive. I mean, you guys own some serious real estate. Can you break down kind of the portfolio that you guys have right now?
Yeah, so we've purchased a little over 6,000 apartment units, and then we've sold. I mean, I feel like the market has been very inflated for a number of years now. It's starting to come back to reality. Yeah. We're starting to see some of that with the loan maturities, over $400 million in multifamily loan maturities over the next 5 years. So we're starting to see sellers become a little more realistic, but we've sold a good amount. So our current portfolio is 3,600 units. We started in primarily just Kansas City, but as of today we have if I can drive there in a day and back, so 4 or 5 hour drive max, that's about our radius.
Smart.
So,
you still want to be able to touch it.
Yeah. St. Louis, we have properties St. Louis, Wichita, Little Rock, Topeka, Columbia. So
the Midwest.
Midwest, exactly. And the markets are they're very similar.
So being from Pacific Northwest, it's funny that we're out here in Kansas City now. And I would almost want to ask you, like, I think Kansas City is like a great place to live. Like from living from the Pacific Northwest and watching the politics down there just go down the tubes. Growing up as a guy, spent 28 years in Seattle, Washington, born and bred, and watching that town go to crap.
Yeah.
And then coming out here and seeing like how family oriented everybody is, how nice everybody is. And they go, I mean, in Washington, I don't know how Oregon was, but in Washington it's close your door, shut your door, don't talk to your neighbors. Yeah. Same thing in Vegas.
Yeah.
Out here, it's like I know all my neighbors and know everybody, and everybody's been welcoming from this city of Kansas City to anybody I meet.
Yeah, I love it here. I know I'm biased, but I feel like the Midwest is the Midwest in that, in my opinion, the weather is the number one thing. It's in Kansas City. It's very unpredictable. You could have an amazing summer day halfway through, and then it's like storming literally by 2 o'clock in the afternoon. Yeah. So the weather is literally the one detractor, but cost of living, like you said, the quality of the people, it's very business friendly. So yeah, I love the Midwest for business. And my opinion is live somewhere where there's a low cost of living. If you want to travel, if you want to go places, go visit, spend a couple days somewhere, you're going to enjoy that city, or you're going to enjoy that scenery that much more because it's, new, and it's, so that's our family, my wife and I, that's kind of been our approach, is we like to travel.
We love to travel.
To raise a family. So we have 5 kids. To raise a family,
Catholic or Mormon?
Christian. So our dad was a
you said that before.
Yeah, like just kind of non-denominational Christian. Yeah.
That's awesome.
Yeah.
I liked we had 2 kids and they were born. My wife was 42, so she was like, we went through the NICU. She's like, no more, we're done. And I was like, let's more is better with everything. More houses, more real estate, more money, more kids.
Yeah.
So I'm on that same approach. The other thing I wanted to hit on the Midwest that I don't think a lot of people mention is that the people get paid here well. Like you say low cost of living, people are like, okay, I can relate. But one thing that I underestimated coming from Vegas, like I'm like, well, the labor's going to be cheap here because in Vegas, the labor's cheap.
Right.
No, guys get paid good out here for framing, good out here for electrical, plumbing, all of these trades and stuff like that. And even to get a job at like Quick Trip, they're making $21 an hour. And so I think a lot of people don't understand that, like, even though it's a low cost of living, there's a high payment for the low cost of living.
Exactly. And I think with remote work and all of that, I feel like jobs largely, the differences around the country are equalizing out to where you legitimately have areas where it's a much lower cost of living, but you can still earn a relatively high income. And so I love Kansas City.
Man, I am so happy that you turned into the Millionaire Mentorship Podcast. It's something that I've been working on for over 3 years right now. We're up to 150 podcast episodes. A lot of them are virtual. A lot of them are in studio, which is what we prefer. If you have a guest that you think that should be on our podcast, all you got to do is comment who it is, and we'll reach out to them. Or if you want to reach out to them and reach out to us, we'd love to have them on a show. We're looking for entertaining, inspirational people that, just like you hear on the podcast every week, that can bring value and help our listening audience achieve their goals. If that's something for you, comment down below and let us know. So as you progress in your career, I mean, I'm sure you look back, I know I do, and you're like, I don't even know how I got here. Like, kind of like, you start this thing with a dream, and the next thing you know, you're like a lot further along than you planned on it. Where do you think is next for you? What is your big audacious goals?
Yeah. So it's funny to totally relate to that. The way I think about a goal these days is there is no goal without attaching the right people that are going to actually carry that out. So it's all people oriented. Right. On the flip side, all of the successes or the things that I'm most proud of or the things that have gone the best, I can point to other people beside myself where I'm like, that's the key person or the key team. And so to me, it's 100% people oriented. Like we have a BHAG, a big, hairy, audacious goal. We want to be $1 billion company by the end of 2031. So we have a lot of big goals, but what I think is, I certainly wouldn't have known this when I was first starting out, or it wouldn't have clicked for me, is the investment is people. And you'll find it's like people can be your biggest frustration.
Yeah.
And I think the where people can get caught up is to say, well, it's frustrating, so I'm going to complain about it, or I'm not going to solve it. It's like, no, solve it, figure it out, become an analyst of, psychoanalyze and figure out what makes people, what makes them motivated and what makes them, and find, take the time to find the great people, because every outcome. So we were just talking about, I want to do a lot of content and educational stuff. So I'm like, who are the right people,
right,
that can help me get there, as opposed to how am I gonna, be the expert myself, or really just put in more hours, or what I've found is, we all have such limited time.
Right.
It's our most valuable, most limited resource, and so it's not about being better myself. It's about finding better people and being strategic with how you put a team together.
Yeah, I've been reading a lot more about that as somebody who's a leader, and you're like, okay, what are my biggest problems? Is maybe I'm not a good enough leader. Like, and when you're talking about finding the right people, and you complain, you're like, well, I'm not a good trainer. I don't have good culture. I don't have the right things that all these people want. So how do I give them these SOPs and these procedures and make them feel a part of a culture, which is what everybody wants. They want to be a part of a culture, a part of a team, a part of a unit. And so that's something that I've reflected on recently. It's like, oh, okay, we really need to spend the time building the core values.
Yeah, exactly.
Building the, like from the book Traction, or from any of the books like Buy Back Your Time, people got to know what you're doing. And as a visionary, I don't know how you compute. For me, I'm like, I just feel like anybody could read my brain. They should know what's in there. And so I totally relate with that. And I'm glad that you said that, because it is a people business, and you can't do it on your own. You got to have the people that support you and can help you get to the next level.
Do you run on EOS? Do you know EOS?
Yes, I do know it. We don't run on it. We've actually, EOS was such a hard thing to put into practice. We tried it so many different times, and we felt like we needed to start with the tasks first versus the whole big thing. Yeah, exactly. And so Dan, I forget what his name is, the guy who wrote Buy Back Your Time, that makes a lot more sense for us now. Okay. And then I think going to the Traction route down the road, because it's just, that's the higher level that you want to get to, but first you got to get the tasks out of your the tasks out. And it's like doing an audit and saying, oh, okay, I'm my number one weakness is I still talk to contractors all the time, and that's like my happy place. When I don't want to have to think about anything and I just want to do something, I'm gonna pick up the phone and talk to a contractor. And that's not the highest and best use of my time, but it's the place I go. And so learning that and trying to basically, as we moved out to Kansas City, for us, building out our team was completely different, because, you don't really think about that. You're like, oh, it'll be fine. I'll find people. And then COVID happens, and it's really hard to hire and all these things. Then you realize you got problems. And we had problems in Vegas with people as well. So
we hired a EOS implementer, so a coach. And then their goal over time is to train it to your team and have your team take it over. And so we've done that over the last 5 years. We had a coach, an implementer, and then we've taken it in-house since. But I swear by EOS. I think it's a great way to structure, especially visionary integrator. Big dreams, trying to do a lot of stuff, but then how do you interpret that and get the team behind it? Like you said, people should be able to read my brain or read my thoughts. But Traction and the EOS system, I think, is a great structure where it's gets your thoughts out of your head, and then the team can run with it.
Well, I look at the big companies who do it well, and I'm like, when I look at the number one company that I think that does the best job at it is I look at Southwest Airlines, and I'm look at like their culture and the way that they do, and they have a good time, and you're always like, even though people, you know, I used to be one of those guys that chased the status on Alaska Airlines, the status on this airline, the status on this one, and then finally when you move to Vegas and Alaska's not really the airline anymore, and then you move to the Midwest, you're like, and you try Southwest, and you just hear it's this cheap airline that everybody, but you're like, wait, I can cancel my flight 10 minutes before the flight.
Right.
They don't charge me for bags. The people are nice.
Yeah.
And I don't have to pay for this upgraded seating. I just have to board.
Yeah.
And so when I look at them, I'm a big fan of culture, Herb Keller and all that stuff. So those are my goals for the future. Jesse, you know, I look up to guys like Carl Icahn. I know you mentioned Benjamin Graham before, and I read Security Analysis. This is like going way, way, way back. Like when I was going to be
the original.
The original, yeah, the OG. I don't think too many people know about Security Analysis. Yeah. And it's not a quick read.
It's not an easy read. I'm like, even
I don't think I got through it. It was one of those books that I bought, I think when I was like 17 or 18 years old, and just trying to learn about the stock market, because that's where I thought I was headed. My goals are to build a REIT and to take it public. Those are what my goals are. Yeah. And I've just started kind of like, I've gone to a bunch of syndication classes and stuff, and just it's a different thing when you're doing it with your own money, right? And then you start asking people for their money, and then you got to kind of explain yourself. Right. How do you? I mean, you've been so long in it. I know you probably don't even think about that anymore because you're like, hey, it's a good investment. Either you're in or you're not.
Yeah. What I actually love the syndication model. So we started out, we were young 20-something kids starting out. And I loved the model of the goal with a syndication, or the goal with raising money, is transparency, transparency, transparency. Right. You're oftentimes sharing information with people who have been there. So a lot of our investors were seasoned real estate operators, investors. Now they just want to be on the passive side. So the more transparent we are, we actually get, over the years, have gotten phenomenal feedback from investors. And actually, I still remember there was a deal, it was fairly early on, where a few of our primary investors passed on it. We were like, well, we can't do this deal because we can't, capital wasn't there, and we maybe even hadn't fully gone under contract on it. We just thought we were really close, and so we had them take a look at it. But that, especially when we were young, very early on, it's like that was a barometer. It was a limiter where it's like, if you can't get sophisticated people to join you in an investment, maybe it's not the best, investment to be doing. And so that was super helpful early on, I would say, but still to this day, I just think the goal should be transparency, and then people can kind of make their own decision. Everyone's kind of in a different life situation of how they're trying to deploy capital, and what are they looking for, cash flow? Are they looking for that future upside? And so to me, it's like the easiest, I tell this to our team who works with our investors, it's the easiest job in the world, because your only goal is to just be accurate in what you're saying and leave it at that. Yeah. So it's fun. I enjoy that, because I do think the investments we do are a huge value add to people who have, there's a lot of people out there who have the very real problem of, I've got capital, it's burning a hole in my pocket, and I really need to have quality deal flow, quality opportunities, and opportunities that, if I'm interested, how easy is it to get answers to my questions? There's a lot of groups out there that, it's like hard to actually get an answer, or they'll skirt around something. And so I feel like we're providing a ton of value just by, for one, offering what we think is a great investment opportunity, but then two, providing a very transparent format. So we do a lot of videos. So I'll do a video tour of like a 1 mile radius of the property, just hop in my car and drive it and just talk about all, the local submarket, walk the property. We do a video, kind of a deal summary. We do a video of all of our underwriting. So walking through the Excel, and, why we've underwritten, things a certain way. And so to me, it's like the most fun type of, I guess I would say it in this way. People could see it as daunting or nerve-wracking, But if you have great intentions, I think it's really just a fun process because you get to interact with, I mean, our investors are incredibly wise. They've seen things, a lot of them are typically older because, you know, most investors have, you know, accumulated wealth over time.
Yeah.
And, you know, people who want to be, who are retired or, you know, really value their time, they're just not wanting to be active in investments. And so, yeah, I think it's just I am all in on the syndication model. I would not do it any other way.
That's awesome. Yeah, completely different from me. I've just bought cheap houses and kept stacking houses. When you talk about like what's next for you, you guys, most people who may be listening to the show, they don't realize like historical tax credits and stuff like that because they don't exist in Oregon and Washington, in Nevada, and it's something that's, you know, out here in the Midwest that you can get. Do you guys typically go after stabilized properties, or do you go after properties that need like a lot of work and a lot of historical tax credits?
Great question. So from our foundation and kind of our core principles, investment principles, we've always been a value add investment company. So we're looking for value, and we typically are buying something that needs a value add, whether it's management, whether it's you know, construction or you know, maintenance, some sort of repositioning. It typically is going to need something, but it's, I would say, a light lift, meaning it's already got in place cash flow. We already really like the asset. Ideally, we're finding something that doesn't match the surrounding market. It's worse than the surrounding market for whatever reason, and we feel like we have the expertise to bring it up to that level. So overarching that, in my opinion, is it's value investing. It's doing what Warren Buffett does with stocks, but doing it with real estate.
Right.
The only difference would be we are actively managing it. So we have our own in-house property management company, whereas he's obviously a lot more hands-off. But very similar philosophy, I would say, value investing, intelligent investor, value investing. But we're opportunistic. So we had our own construction company for a while, so we built a 336 unit property.
How was that?
You know, I loved it.
It's a big one.
Yeah, and I loved. I would say one thing we've learned over the years, and every time I say we, so there were 3 of us original brothers. We bought out 1 brother, and so now it's me and my brother Joel.
Okay.
But one of the things that we've learned over the years is just, what are we focused on? Like, what is our expertise? And I think what we found on the construction side is, while there's a lot of value having your own internal construction crew, and we would do it for our turns and things like that, it was pretty time intensive and just focus intensive, and just having our focus on buying and managing and not trying to squeeze out a small margin on the construction side or on the renovation side is kind of why we went away from that. But we've done, so we did the historical tax credits, so the Flash Cube building. And so we've done some of these that are a little more creative, like a new build type of thing. We've also partnered with builders where it's a merchant builder. They've got the land, they've got plans, they're maybe building out duplexes or fourplexes. Their idea is, I'll sell them off one at a time. We'll come in and say, we'll buy the whole thing. We'll agree on a price in advance on the whole thing. We'll close in tranches, and we'll add a clubhouse and pool, something that they didn't have in their plans, and run it as an apartment community. But that's been opportunistic, I would say, starting in 2015, 16, right in there, when the market really started to heat up. We were just running the numbers, and it's like, I mean, there was a period in there where the value add strategy, I'm talking on apartments, the value add strategy, cap rates actually dropped below on value add distressed properties, sometimes newer, you know, a lot newer, nicer product, because it was such a kind of buzzword.
Right.
And so there was a period where it was a lengthy period where pricing was just outrageous. And so we saw opportunities, just greater ROI, greater risk return profile on some newer product, and so for Flash Cube and some of these other types of deals. Whereas now, like, so we bought 2 properties last year. Both of them were down the middle of the fairway, classic value add deals, 70s product that we felt, could be repositioned, a light value add. And so I think we're coming back into where more of what we're going to be doing is more of that traditional value add. And I've heard that from, I've had mentors over the years and stuff. I've had one gentleman owns 30,000+ units, and he said,
wow.
He said, yeah, when the market is hot, it's the newer product that pencils. And when the market cools down, I buy older existing product. And we haven't set out to emulate that, but we've found that to be true in our in our investing as well.
So where do you guys see Kansas City right now in terms of investment strategy? There's a lot of things going on politically that, like with the KC tenants, and a lot of these organizations that are. I'd love to hear your thoughts about that.
I'm not going to say anything negative about the
KC tenants. I will just say that I've invited the leader of KC tenants on here to come on, and she has respectfully said that she doesn't want to do any public dialogue with me. So I think she doesn't agree with my point of view on things, but I understand for that. With what I mean by that is, like, there's a lot of opportunities downtown. Yeah. Are you trying to do deals in Kansas City, or are you kind of holding off because of the current political climate?
Nothing political climate related. I mean, we are really just opportunistic buyers. I feel like traditionally, historically, we've done most kind of garden style, suburban value add deals. That is our comfort zone. And if a deal makes sense, it pencils, there's some aberration where we think there's value, we feel like anything within the vertical of multifamily we're very comfortable with. And there's a lot of groups, like I talk to investors around the country, and the feedback I consistently get is we're pretty unique in that we have a relatively narrow niche focus geographically, and then a very narrow niche in that we only do multifamily. So a lot of groups that are of our size will do multiple food groups. So they'll do industrial, or they'll do, they'll go into storage units. They'll branch out, or they'll be in a broader geographical area or around their country. And so for us, we feel like our goal is to be the best in the world at something kind of good to great, hedgehog concept mentality. And so we feel like anything within that vertical of multifamily we're comfortable with, but most of the value and the thing I think we're going to do most of, and you asked about kind of our growth plans, I would love to just continue to improve our systems within our organization and just expand, especially whenever the market is more favorable for buying, be primed and ready to just be buying on a broader radius, and improving our internal operations to operate those as efficiently as possible. So it would be, 3,500 unit portfolio right now. If the market shifts, I'd want to be able to buy 2,000 units in a year if it was, a really great market for buying.
So Jesse, at this point in time, you've been doing it for a long time. Do a lot of these deals just come to you, or are you guys actively searching out deals?
Oh yeah, no, it's we have a 3-person team. So we have a VP of acquisitions and then 2 analysts, and all they do. So last year we underwrote over 300 properties and bought 2. And so very much it shifts with the market, but that kind of old adage of look at 100 properties, maybe go deep on 10, offer on 3, buy 1, something like that. We definitely end up following that.
Smart.
And so, yeah, we absolutely have to seek them out. So part of why, we did that speakeasy, I want to be connected with all of the owners, friends with them, golf with them. We kind of operate on that abundance mentality. I don't think I have any trade secret that I wouldn't share with any other owner. What are we thinking about the market? Why are we doing what we're doing? And I think that ultimately comes around, in a positive way. Not that it needs to. And so, knowing the owners, reaching out to them, I'd love there's a lot of times where transactions, you're really helping someone. They've got a problem, they've got ballooning debt, and they need to transact quickly. would love to be the first call that they make. So,
Right.
so being connected with all of the owners, all of the management companies, being connected and having strong relationships with the brokers. So we kind of consider it like the great sin if we go under contract and we don't close. We want to have the reputation, and that's very important in the broker community. Of brokers want to bring you deals because you do what you say you're going to do. You don't retrade unless it's a really egregious thing. And so all of those factors kind of come together where, I mean, we'll get a deal any way it comes to us, but most likely it's, we're out there in the marketplace, looking at deals.
You could burn out a lot of people really quick by putting a lot of deals under contract, and then saying, we need to renegotiate or this or that. There's people who are going to get tired of dealing with you because, 100%. Closers close and the other guys just, hang out. Now, a couple of properties I've looked at here locally. One would be the Federal Reserve building, $925 grand. I wanted to talk a little bit about that property. Because I found, as you look at all these deals, you find little nuggets of information that leads you clues, and you're like, oh, wow, I didn't know I could raise capital like that. Yeah. And so I don't know if you're familiar with how that building, the capital was raised.
Very familiar with it. We've looked extensively at lending on it. Okay. So that's another reason why we have our private lending company and our property management company. You have tentacles into the industry where someone will bring a deal to you. And in fact, we bought apartment communities where someone brought it to us looking for a loan. And then we were like, wait, we actually could buy this. And so, yes, I know that building very well. Fascinating group and fascinating, way to raise money. I don't know the particulars of, the foreign, I don't know that.
Do you want me to break it down?
Yeah.
I've taken a deep dive. In fact, that's one of the mechanisms that we're going to be using to try to raise capital, because it's kind of like the same, and that I stumbled on about, because I'm like, how is this building sitting here for 10 years and not a damn thing's been done on it, but he's still afloat? So, most investors are looking for a return. With the EB-5 visa, they're looking for a visa.
Right.
And so your return, the investor's return goes down. The other thing is the minimal investment that they can make is $825,000.
Right.
So and it usually ranges from $825 to $1.2. So that brings down. And so what I did is we scraped all of the top 50 cities for immigration attorneys, and we're putting together what is called a video sales letter, or VSL, where we're going to break down and say, hey, we're really good at buying properties. You're really good at getting people immigrated, but they probably don't have the properties. And you can see, like, when a guy who's really good at raising capital and putting that together gets into a real estate business and doesn't have that upbringing that you and I have had, they can't get it off the ground.
Yeah, the fascinating thing to me is, what is the fiduciary responsibility to execute on the business plan? Because as I looked into it, there just seems like a lot of properties that are sitting there stagnant and nothing's happening with them. And so I don't know the answer to that, but it seems, it's a fascinating thing. I mean, people are literally buying their way into the country.
Well, it happens everywhere else. I just didn't know it could happen here.
Yeah.
And I heard that Jared Kushner, basically, that's how his whole entire operation runs.
Interesting.
So that's why, I'm hot to trot on that, because I was going to go syndication route through our social media.
Yeah.
And I just felt like it'd be easier to go immigration syndication route and then target specific individuals, attorneys, and say, hey, you guys are good at getting people immigrated to the United States, but you probably don't have properties, because they probably don't have a lot of people they can rely on. In fact, the guys who own 925 grand, I've talked to them several times, and they're the guys who started that, I think you know who they are. They had one of their buildings in Jacksonville, Florida, get blown up by the city of Jacksonville. Like, literally, they bought it at the same time they bought 925 grand, and the city literally has a ceremony of them pushing the big boom and blowing it up. And who knows what's going to happen with that one? But I talked to Rob, who's the kind of the main guy there, and I'm like, if you don't partner with someone local, like, you're probably screwed.
Right.
And I think he partnered with somebody from
but is that okay? But with their model, does it even matter? Like, do they even have to deliver a return?
They do, yeah, because the whole point is that you're creating jobs. If you're not creating jobs,
interesting.
So they're not creating jobs. So they're in violation right now of their situation, because the whole thing is that it has to be part of that EB-5 is that you have to create jobs. They may have had some jobs they created through the demo.
Right, which they did.
Yeah, but right now I think they're in deep doo-doo. And I looked into, because he told me he was partnering with somebody else, so I looked into who they were partnering with, and I'm like, I said, you really need a local presence. I think that like so many people don't understand that like you're an outsider until you're really an insider. And in Kansas City, I'm still an outsider because I haven't been here long enough. And so in order for me to have good relationships with people, I need to partner with somebody who really, like my attorney, for example. My attorney knows everybody and they respect him. And I'm like, just come with me. You know, if I'm with you, I'm in a good situation.
Yeah, exactly.
So with a property like that, a 925 Granite, would that be something that you guys would take down?
Potentially, yes. I mean, we've looked at that, and part of when we lend on something, we always, in the back of our mind, we want to be able to have a pathway. Hey, what would we do with this if we took it back? You know, what's it worth in a fire sale scenario? And then, you know, what's the pathway to develop it? I would say our bread and butter has not been, you know, development. We've done it opportunistically. And so I would say we're getting involved in something like that where we think it's a quite an outlier, and we think even if we had a misstep here or there, we just have underwritten it conservatively enough where we think it's going to go out. I mean, that's a beast of a building. And
207. Wait, there's two of them that are big, but that one's a monster. I think it's almost 300,000 square feet.
It is, and it's got the parking garage, you know,
off the back.
Off the back, and I mean the condition of it obviously is
torched.
I mean, it's probably the worst condition property, I would say, in Kansas City in terms of just how much you'd have to do to kind of bring it back, and so that would be my biggest reservation would just be having a partner or having someone on the team who really understands that building.
I almost think you got to partner with like a J.E. Dunn or a Rao Properties as like having them have some skin in the game, so that you
didn't Rao do work on that? I think Rao
they did. They did the demo. They actually had a lien against it for a while there. For the demo, and you look at that thing and you're just like, you know, that's gonna trade hands eventually. It's like, you know, someone's gonna end up picking it up. The other one that's interesting is the Scarrett building downtown. That one got sold by a guy named Wayne Reeder to another person, I think Sunflower Development, and then it got bought for I think $7 million by these guys out of St. Augustine, Florida. And they had the Embassy Suites pen, and then they changed to multifamily. And those projects are so damn big. And they take so much work, and there's so many things that can go wrong, that will go wrong no matter who the team is, that you have to be underwriting them so conservatively. So I'm really curious about your underwriting process.
So new development, construction, not our wheelhouse. So if we're doing that, like we had a construction team when we were doing more of that, and so we would, you know, rely on, you know, the experts on our team or consultants, things like that. But on the underwriting side, I mean, in terms of where I feel like there are certain metrics that almost define organizations in the type of real estate that they do. So you've got a lot of people who are on the development and construction side. They're all IRR driven. You know, what's the quick turn? You know, what's the once we're out of this, what's the overall return? We are cash on cash return, pre-sale cash on cash return obsessed. And so it's
I'm going to interrupt you for a little bit, because I think that's an important point you just brought up, because IRR is bullshit. So whoever's saying IRR, and it's Grant Cardone, like it is a projected rate based on what you think might happen.
The problem with IRR is, and I think if you just pull up a spreadsheet and you just tinker with the decimal points on an IRR, the exit sale price dictates that IRR so dramatically, and it's a future value guess. It's a future value. But it's a guess in the future that is so determined by things outside of your own control. It's just not, in my opinion, good practice to put a ton of weight on the IRR, because literally it's a guess.
It's a total guess. It has nothing to do with math, and the math is made up by the guy who's guessing. He's like, I think it's going to be worth that. And if they're selling on the IRR and they're not selling on cash return or any other measurable matrix, it's really, to me, just smoke.
Yeah. And the way I look at it is the more if there's a conservative exit cap, then it's going to align with the pre-sale cash on cash anyway. So if the pre-sale cash on cash is strong, you're going to naturally produce a strong IRR in relation to that. And so to me, it's like focus on the numbers that if it's right, the rest of them don't matter as much. And so we look at pre-sale cash on cash. And so it's literally the obsession of what's the rental growth rate, what rents are we bringing it to, and we just want to have a ton of data and a ton of our own experience. So we, in our spreadsheets, every line item in our underwriting, we have it mapped to our existing portfolio's numbers. So we can see, are we 5% higher than our existing portfolio? And then we have it broken down to the asset types. So maybe a Flash Cube or a 909, it's a different asset type. So then we can say, hey, how are we underwriting this in relation to similar properties, a suburban garden style apartment.
Right.
And so that is where we, you just have to have that dialed in and ideally be on the more conservative side. The less confidence we have in a number, the less data we have on that number, the more we want to dial that, on the conservative side in case an unknown comes about.
So I know we're getting short on time. I did have one other question that I wanted to ask you. It's hot on everybody's mind right now, and it's about the Kansas City Chiefs and the Royals right now.
Yeah.
I have a suggestion that I'm actually working on. I'll tell you, I don't really care because I put it out there so many times, but I feel like it's so hot right now with Kansas about ready to swoop in and take the Chiefs, which would be devastating for Missouri, really.
Right.
And I'm like, you've got 674 acres right there on the river that's built with the lowest best use, which is the Kansas City Municipal Airport. If you wiped the ground with that whole place, you could put all of your stadiums right there. You could put everything right there.
Yeah.
My question for you is, I'm just showing you my vision, but my question for you is what does Kansas City need to do to keep them, and do you think they're going to keep them?
Yeah, so I would love, this is what I would do, is I would have a really aggressive educational campaign for the existing site, the KC Star building. I actually think it's a great site and great location. I would just have an aggressive educational campaign because, in my opinion, the stats and the facts are on the side of this should get approved. It should be a no-brainer. But there was so little communication to the public on where the site could be, and that kind of came out of nowhere at the very end, where to win over public approval on that, and does it make sense, and what are the studies and all that kind of stuff.
Right.
How much is the team participating? I mean, all those stats are incredibly favorable, meaning, in my opinion, if there ever should be an approval of a site, it should be the Royals coming downtown. And I'm biased as well. I have downtown property, so
I'm totally biased. I want them down here.
But I think it's good for the city. I mean, I think baseball is not exactly the booming sports market, but when you come downtown, it's like you have so many businesses that would get a suite, and instead of meeting at a restaurant or somewhere, it's like, let's go catch a game. Right. We've got a suite. I mean, I just think it makes so much sense where it becomes more like a social gathering, or to go out to the stadiums, it's not as easy.
There's nothing
to do
out
that.
there.
Yeah, there's
so
nothing.
You want to
out
look at
there
the Adams Mark property as you
Right.
get pass by Club Skin.
Yeah.
And then
Yeah.
it's like
exactly.
it's the worst location
Yeah.
for it.
Yeah.
And the only thing good about it is you got a big parking lot that you can tailgate
Right.
on.
Exactly.
But other than that, it's I think you open up the riverfront, you do it on the you drag everybody to town, have a walkway down across there so people can park downtown. Similar to what they did in, I don't know if you remember in Seattle when they blew up the Kingdome. When they blew up the Kingdome and they put Safeco Field and then they put CenturyLink, it changed that entire region. And I think that what you mentioned is, we may be biased, but bringing a sports team into town brings life into town, and it makes all the businesses do well.
Exactly.
And right now, you really don't have anything. You got the Sprint Center, but that's only for concerts and only at night. And then when you come to one of those concerts at night, you'll notice that there's people everywhere.
Right.
You
Exactly.
know, and people want to be downtown, and when your downtown is vibrant, so is the rest of your city.
Yeah.
And I think that my last question would be pertaining to city and stuff like that. Have you guys used any sort of mechanisms like SIDS, LIDs, tax increment financing, or anything like that to move your deals forward, or do you guys plan on using those in the future?
No, certainly not experts on any of those things. We inherited some of that with the 909 project, so some of that had already.
My attorney did those for that one.
Okay.
Yeah, he told me about that. He's like, yeah, I structured the bond instrument.
Yeah,
for that.
exactly. So, no, I mean, we are, I would say at a high level, we are down the middle of the fairway, market rate apartment buyers and operators, and I absolutely think there will be a point down the line where we want to make some of that more creative. I would just consider a little, anything like that, just more exotic in terms of bonds and how you're financing something. And that's way more on the development side. I could see us wanting to develop that vertical down the line, but until we hit our limit or hit a ceiling with just growing our existing verticals, my ideal would be, again, be the best in the world at something.
Right.
And I still think we have room to grow and things to improve on being, our goal from the beginning has to be the best multifamily acquirer and operator in the greater Kansas City area.
Okay, so 2 final things. 1, how do people follow your story, your journey?
I mean, we don't do much marketing or social media or anything like that. I mean, we have our website, and I would say down the line, my goal, that's why I'm gonna pick your brain, is how to, and really my passion is educational content. It kind of goes to the way we fundraise for our deals. It's like, we're not selling anything, we're just educating and being transparent. And so just to expand that, we do a lot when we have an opportunity, but we don't do a lot about kind of the broader investing process or just passively investing in general. So I would say that's a TBD.
Okay.
Yeah.
And then final question is, if somebody's interested in investing with you and they're listening to this podcast right now and they can tell that how transparent and sincere you are, they know that you've been in the business a long time, and they're like, all right, I'm interested in what these guys have to offer. How do they become an investor, or how do they get a hold of you to become an investor?
Yeah, our website, Worcester Investments, is just the best way to look us up, or just Google Worcester Investments, and there's contact information on there, and you can do the chat bot or connect with the team. We've got an investor relations team that is, I think, second to none.
Right.
And they really take the approach of educating and answering questions, and never like, moving you towards an investment. Yeah. It's hey, let me answer your questions. Let me be a value add to you. And so I can recommend that highly, that even just connecting with the team, if someone is interested in learning more about real estate or investing in general, the team's a great resource.
Awesome. Well, I appreciate you coming on the podcast.
Yeah.
I was really excited to meet you. Like I said, I went to your party, you stood me up, and so I figured I had to get you. No, I'm just messing with you. I'm
so glad you came. I didn't even know you were there. That's
absolutely.
Cool.
I was like, well, I'm going to go meet him today.
Did you grab a cocktail and some food?
Well, I actually don't drink, but
I don't either. So
yeah, but I did enjoy the food. I enjoyed the music. I enjoyed the whole setup.
Yeah,
I was like, looking as a guy who's trying to start my own, I'm like, these guys are doing everything right. That's the way I left the meeting. I took your flyer, I put it in my car, and I was like, this is a great leave behind. There's like the only thing that was marketing in that entire room was a sheet of paper that had a pie chart on it. And I just felt like, that's the best marketing. Yeah. Because when you're out there and you're inviting people and all of a sudden they get a sales pitch or they get this, they're like, oh, okay, that's why I'm here.
Yeah, exactly.
Versus like, well, they didn't sell me anything, but I want something. Yeah. And so that was really cool. I think you guys did a great job on that. And I'd love to keep in touch with you. The final question, selfishly, that I would ask you is like, would you guys ever consider partnering on a deal with, because you guys are really good at syndication. I always feel like the best way to do something that you're not good at it is to partner with somebody who's good at it.
100%. So our fund, we have invested with other groups. We are just the deal is the holy grail. A good deal finds partners, it finds the right people. And so that would be our starting point. But we look at so many deals. We actually have a great system for if you're doing something, absolutely send it our way. We'll underwrite it quickly and give you quick feedback on it. And we do look at a lot and say no to most things we look at.
I would love to underwrite a deal with you guys, like, because I'm looking at the Poindexter building.
Yeah.
And I know that 909 is off the table, but if it comes back on, let me know.
Yeah.
I'm definitely interested in that one. But we're looking at the Poindexter building,
Yeah.
and you know, that's probably the one that I'm looking at the most, just because I see, like, as this stuff gets going in Kansas City and continues, I think that parking garage is a brilliant play right there. Maybe sell off the additional investment, keep the parking and stuff like that. So there are a lot of properties that I've looked at, but I'm just like, you know, for me to raise capital, I believe I can get the construction done. I believe I'm a bull when it comes to that stuff. I'm just going to get it done. But I don't want to underwrite it because I don't know what I'm doing in that regard. And so for me, it would make sense to partner with somebody who's done a lot of those things versus go out there. And I was going to do that with Caleb on actually your property at 929, but then he's like, you're going to be the capital guy. And I'm like, yeah, that's not really where I'm like, yeah, like, you know, that's not why we are doing that. And so I felt like it's too small of a deal for us to partner on, take it down on your own, and we'll find the next one.
Consider us a resource. I'll connect you with Bryn. He leads our acquisitions and geeks out on underwriting. I mean, him and the team, they live in looking at deals and looking in spreadsheets, running models all day long. And so consider us a resource at a bare minimum just to look at a deal together. Happy to do that.
Cool. Well, Jesse, I appreciate you coming on. Super impressed with your success, with you, your brother, your team, everybody that you got around you. You seem like a super humble guy, and I can see you're going to go places. I hope you hit that $1 billion mark before 2031. I think you will, probably, just the way things are going. So appreciate you coming on. And guys, make sure you give us a 5-star review, and we'll check you on the next one. Peace. Hey, thank you so much for tuning into our podcast right now. I am so happy that you are here. You are in the right spot to be getting inspired by other people that have just achieved their goals so that you can achieve your goals. Do me a favor. Leave us a 5-star review. It really helps us grow. And give us comments and feedback. So we read those. It helps us grow. The most important person in this podcast is the listener, right? And so if you give us your feedback, it will allow us to create a better podcast for you. And make sure you enjoy the show and leave us a 5-star review.